Okay, let's just jump straight into it. Welcome to The Explainer. Today, we're tearing down the exact mechanics of how insurance contracts actually protect your finances from the unexpected. If you've ever paid a premium and thought, what is actually happening behind the scenes with my money? Well, you are definitely in the right place. We're going to focus in on the precise nuts and bolts ways these agreements are structured to shield you from risk.
So here's our roadmap for the breakdown today. First up, the promise of protection. Then, the 7 guiding rules. A policy for every need, weighing pros and cons, and finally, we'll look at the global insurance giants.
All right, part 1, the promise of protection.
Now, the absolutely crucial thing to remember here is that insurance isn't just some vague safety net. No, fundamentally, it's a binding contract. It's represented by a specific policy where you or your business are guaranteed financial protection or direct reimbursement against losses from an insurance company. Basically, you're trading a known smaller cost right now for an ironclad legal guarantee of a payout when disaster strikes. But how does that actually work, right? How can a company afford to pay out massive sums if everything goes sideways? Well, the secret sauce here is risk pooling. By combining the risks of thousands and thousands of clients together, the mathematical odds of everyone suffering a huge loss at the exact same time drop to pretty much zero. It's that shared burden that actually makes your individual premiums affordable in the first place.
Which naturally brings up a really vital question. When you have literally thousands of people pooling their cash and transferring their risk to one single entity, what's the underlying framework that guarantees these promises are actually kept? Like, how do we make sure the system stays fair and doesn't just get completely exploited by bad actors?
That takes us to part 2, the 7 guiding rules. And listen, these aren't just polite suggestions. They are the 7 foundational ground rules of the entire industry. It all kicks off with utmost good faith and insurable interest, which basically means absolute honesty is required on both sides, and you have to actually stand to suffer a real financial loss. You can't just insure a random stranger's house, right? Then we've got principles like indemnity, contribution, and subrogation. Those ensure you're made exactly whole after a loss, but no more than that. There's no profiting off a disaster here. And finally, loss minimization and causa proxima ensure your claims are tied to direct, immediate causes. Together, this whole shebang keeps the system mathematically sound.
Moving right along to part 3, a policy for every need.
Broadly speaking, you're looking at 8 main types of insurance designed to cover, well, almost anything you value. We've got the major heavy hitters: life, motor, health, property, and travel. But the flexibility of these contracts is wild. It extends perfectly to everyday stuff too. Think mobile insurance for your smartphone, cycle insurance for your bike, or even these bite-sized insurance policies for highly specific, super short-term needs. You can literally tailor your protection to fit exactly what matters to you. And I want to spotlight life insurance specifically for a second, because this contract takes protection to a whole different level. Unlike property insurance, where you get reimbursed for a busted asset, life insurance is a solemn contract promising to pay a designated beneficiary a set amount of money upon the passing of the insured person. It brilliantly illustrates how these agreements can stretch way beyond your own lifetime to provide long-term crucial financial security for the people you love most. Okay, on to part 4, weighing pros and cons. Let's take a step back and objectively weigh this out. The advantages are absolutely massive. I mean, these contracts give you fundamental financial security, they encourage structured savings, they pool funds that actually help boost international trade, and of course, they expertly spread risk. But there is a real trade-off here. Being bound by these agreements means you are navigating some incredibly complex, long legal formalities. You're also exposed to potential fraud and agency risks. The ongoing premiums can get pretty expensive, and you have to face the harsh reality that temporary policies can just be suddenly terminated. So it's for sure a balancing act.
Finally, part 5, the global insurance giants.
So for this whole concept of risk pooling to actually work, the pool has to be unbelievably deep. And that is exactly why the top 10 global firms span the entire planet. Over in the US, you have massive representation from Prudential Financial, Berkshire Hathaway, and MetLife. Over in Europe, giants like Allianz SA in Germany, AXA in France, and Legal & General in the UK are leading the charge. And then, dominating the Asian markets, you've got Nippon Life in Japan alongside Ping An and China Life. It vividly illustrates the immense international scale that is required to effectively pool risks and guarantee protection for millions of people globally.
As we wrap up this explainer, I want you to consider the contracts that are protecting your own life, health, and property right now. Do you fully understand the 7 principles governing those agreements? And ultimately, when you look at your own specific financial situation, do the huge benefits of pooled risk truly outweigh the legal headaches of the fine print? It's definitely a question worth asking the next time you sit down to review your policies.